6, and we have a very special guest. His name is Levi Allen. So since 2012, Levi has grown a real estate portfolio worth of over $45 million, consisting of 462 multifamily units. And, you can find more information about his business, and you can get in contact with him personally as well. So the website is called wealthcreationmgmt.com. And for Instagram, Facebook, of course, all these personal social media links are going to be there in the show notes as well. So Levi, I just want to say a big thank you for joining me today on this episode.
Yeah, thank you, Martinez. Appreciate it. Excited to be on.
Thank you. It's my pleasure for sure. So look, real estate, multifamily. I mean, those two things that people love a lot when they come to this, podcast. They love those type of investment vehicles. So maybe again, before jumping in real estate and talking about that, where you're investing and for what reasons, maybe uncovering why and where are you coming from personally, and why have you decided to pursue the real estate business?
Yeah, for sure. So I grew up in a small town on a cattle ranch and a potato farm. Grew up with a good work ethic. My parents, they really came from nothing. And my dad started working for a guy of the name of Cal Worthington. He's worth over 500 million. In today's dollars, he'd be a billionaire. He passed away a few years ago, but he he wanted to grow potatoes, and so he kind of just wrote the check for my dad. He told my dad, just go out, buy all the equipment you want. And so he just wrote a check for a couple $1,000,000 to buy all the equipment he needed. And my parents got in the business of farming and mainly growing potatoes kind of on his budget. So they were able to learn on his dime. And, and over the years, they've been able to be really successful with that business. And me having grown up in it, it's agricultural is a part of real estate, but it's really more management intensive, and it's a little bit harder to scale, and it's just a lot of hard work. So I kind of early on hearing books like Rich Dad Poor Dad, ABC's of Real Estate Investing, all the top real estate books, I knew I wanted to be in some kind of business or real estate. And I also kind of wanted to do something on my own and not with the help of my parents, just to kind of prove that I could do it without their help. And that's kind of one of the main reasons that I ended up moving away from the town where I grew up, to Utah, which is a really good real estate market. And yeah, I'm kind of all over the place, but.
No, but look, Levi, I'll give you a lot of credit. Like, for one thing, as you mentioned, like, you have something to prove. I mean, it's nothing wrong, but it's your personal kind of driving force, proving your parents, look, I don't need the inherited business, I can do on my own. Because again, one thing that nobody can, hand you, I mean, it's not going to come out from the book, even though like Rich Dad Poor Dad, like, great book. But one thing that you cannot get from the book is the work ethic.
So yeah, that's kind of the reason that I got into this. I really gravitated toward the syndication model. I started following Michael Blanc and bought his courses, learned underwriting, and then started just networking in the business. So over the years, I had built up a cattle portfolio. I ended up selling that and had some cash to buy an 8-unit property. And then I also bought some land with my parents that I was able to pay them off with the cash flow of that over the years, and sold that, 1031 that into a 10-unit property. And then pretty soon you're out of your own money and you're like, well, I got to keep growing this. How do you scale? And I just gravitated toward that syndication model. And over the years, I've kind of just came to the realization that I don't really care what other people think about me. Maybe they think I'm just a rich kid, but kind of priority is to help my family preserve and grow their wealth. So I've kind of transitioned my model to more joint ventures and just finding a few high net worth individuals for certain deals where we can be a little more flexible on refinancing or 1031 exchange. Because the syndication model, you kind of got to just plan on a sell at some point and everyone gets their capital back. And it's really hard. It's almost impossible to 1031 exchange. So yeah, that's kind of what I'm focused on now, is just a few high net worth individuals and just doing a smaller partnership on deals.
Through the joint venture. Okay. So,
Yeah.
but at the same time, like I do understand, like you can become really wealthy with like land and, cattle and, being a kind of in, as you mentioned, agricultural side of the business, because it's definitely it's real estate because it's land. And I knew
Yep.
personally when I was growing, and when my grandma was alive, I was going to her village and I was working, on lands as well in the summertime. And, I was doing a lot of work like physically with cattle and, so that was a lot of fun. So I do understand that part of the business. At the same time, it's tough work. And that's where you come back again from the point of having that work ethic in you, because I mean, it's a tough job, and those people like waking up 5 in the morning, going to bed 12, and that's they go in like 7 days a week, so it's a tough job. But at the same time, you're talking about scaling business, helping your family to preserve the capital and grow it over time with with multifamily. So can you talk about again the first deal that you mentioned? You sold was it the cattle or the land that you sold into 1031 into 10 unit?
Yeah. So on the 8 unit, it was just an 8 unit property here in my hometown. And so I was able to get seller financing on the deal. It was 347,000. I had to put 90,000 down. So I had that money from selling my cows. And then it was nice to get the seller financing, because usually your first deal, you can't really get bank financing unless you have a partner that comes on with you to sign. So that kind of got me in the door, that deal. And then the 10 unit, that land, so I bought it for 105,000 back in 2012, and then I sold it in 2018 for 260,000. And I had paid off my parents with the profits from that land over the years, the farming it. So I used that 260,000 to put as my down payment on the 10 unit in Utah. So now I've got 18 units and I'm building credibility with lenders and investors. And that's when it was about a year after that I got into a 124 unit partnership syndication. Yeah.
And you were a GP or an LP on that deal?
A GP, yeah. So I found the deal. It was in Texas. So sourcing deals with brokers, an off-market deal. I found it. Went to a partner that had a lot of units in that area. He was the lead sponsor on that deal, so he does all the asset management. He raised most of the money, so I raised a little bit of the money, and I found the deal. I put up the earnest money, and yeah, and then I've gotten into one other big deal with him as well. But like I said, since then, I've kind of gravitated more to joint. Not that I'm opposed to doing more syndications, but when you've got 50 investors on a deal, it's just, you got to have a lot bigger infrastructure for reporting to them. And then you got to plan on selling it at some point. It's not as easy just to, let's refi this thing and hold it.
And your partners have no problem with that?
Yeah, so like the last deal we did, I had two partners that both put in over 7 figures. And then I put in 200,000 of my own money, actually from refinancing the 10 unit. But it's just, I like the model more that, I'm going for cash flow anyways. And the deal penciled to where I didn't have to do a preferred return. We just did a straight, I think it was an 85-15 split. So I'm getting like 6,000 a month cash flow on that deal, and they're both getting, almost 5 figures cash flow on that deal. And yeah, it's just a little bit easier to be flexible with what we want to do with it.
Power of the, doing the JV versus right now versus the syndication. Like, I do understand why you're taking that approach, because a lot of people, the way they look at the deal. So of course, maybe we can go a little bit in depth on the markets in Utah and, Texas, and why you're investing in those markets, so like particularly Texas. But it makes more sense to kind of do JV, and a lot of, multifamily syndicators talking about that, a lot. And I hear that a lot because it doesn't make sense to structure the way to structure the deals that will benefit, passive investors at the moment.
Right.
So
Yeah.
yeah, so it does make sense. So talking about the markets, can you talk about again the Utah market versus Texas, and for what reasons are you investing into Texas market?
Right. So job growth is probably the most important thing. All other things created equal. If people don't have places to work, then they're not going to be going to look for an apartment to rent. So Utah, it's like right now, even post pandemic, we're 4.1% unemployment rate, just top in the nation for job growth. There's a limited supply of land, so that has an effect on rent growth because you can't just keep building everywhere. And yeah, the rent growth's good, population growth is good. Same sort of thing with the Texas markets. San Antonio is where I've got ownership in those properties, which is a little bit more slow and steady market, which has its pros and cons. You can buy at a little bit higher cap rate, but there's going to be less rent growth, a little bit more vacancy. So you can make money in any market, as you know, but yeah, I'm kind of just more focused on being within a 6 to 8 hour drive of where I live. So that's kind of why I'm more focused now on Idaho and Utah, where I'm doing the asset management, meeting with the management company, checking on renovations. So that's kind of my focus now.
Got it. So when you mentioned about the Utah and the job growth, and like it's like one of the, as you mentioned, one of the top states when it comes to job growth. So what's like who's the dominating companies? Like, can you mention a few that will be kind of for people to pay attention to? Like, what type of companies
Yeah.
coming to Utah?
So tech is probably the biggest thing that's driving the Utah market.
Of course.
So like Adobe, Snapchat, Facebook just built the center. Amazon built the distribution center. There's tech is probably the thing that's bringing the higher income jobs to the area. And then there's a lot of more trickle down jobs that come from that.
Mm-hmm.
So yeah, tech is kind of the biggest driver. There's 5 top D1 universities in Utah. Healthcare is pretty big.
Same as Texas. Texas is driven a lot on the healthcare sector, right?
Yep.
Yeah. Okay. So looking for the deals itself, as I mentioned, you're going to be looking in Utah, and what is the other state that you mentioned close by?
Idaho.
Idaho. Okay. So when you're actively looking for deals, can you talk about your underwriting, criteria and the deals? So like what type of deals are you going to be looking for?
Yeah. So in the past, I've mainly looked at value add deals, just the typical class C, class B value add where you can go in and renovate units, get a rent pop, but it's still got cash flow day one. But I'm kind of moving away from that model because there's so many people looking for value add deals, especially in Utah, like in the Salt Lake Valley. There's value add deals that are trading at really compressed cap rates, like sub 4 caps. And I just don't see the risk versus reward on a risk adjusted return. It doesn't make as much sense to me to pay that and spend the extra money and have uncertainty whether you can get that rent increase and the affordability of it. So like this last deal we did, it was completely renovated to the studs. The guy that owned it before me, he put $60,000 per unit in renovations into it, just a complete gut, and he did it really nice. It's like a class A property now. Quartz countertops, undermount sinks. He opened up the units. He literally replaced everything, including plumbing and electrical. And I was able to get it at a 6 cap. So, and my debt is at 3.28, 5 years interest only. So we're over 10% cash on cash, and there's still a little bit of upside in the rents. And then we've got some extra land we can build 12 more units on. So it just makes a lot more sense to me to buy a deal where it's a little bit higher cash flow. Our break-even occupancy is 55%. which for Utah, like according to CoStar, during 2008, 2009, occupancies only got down to like 91%, and rents dropped 4.5%. So like things could get 5 times worse and we'd still have positive cash flow as long as we're managing it right. And so yeah, I'm kind of more, part of it is my investor base. You kind of got to tailor the deal to whatever your investors are looking for. And me kind of moving more to high net worth, just a few investors. They're more looking for cash flow, capital preservation. We haven't even talked about tax benefits. Like we're going to get $3 million in bonus depreciation on this deal. And with the CARES Act, you can carry those losses back 5 years. So, you know, my 2 high net worth individuals, they make over $1 million each a year, and they've been paying a ton of taxes. So we're going to, you know, they're going to offset their taxable income this year and maybe have some losses to carry back to get tax refunds. So yeah, kind of just tailoring to whatever your investor base is like, and then figuring out what kind of business plan works for that.
Okay, so that's very interesting. I mean, when it comes to the deal criteria, kind of looking for these like wholesale type of deals. So somebody came in, kind of fixed up the property, and you're looking to buy them, you know, for, you know, lesser price than an A-class brand new built property, which you're still going to get the quality close to that, right?
Yeah.
With some available land. So are you looking specifically for deals that you can build something on the available land as well? Or are you looking kind of, so what size of the units, like how many units are we talking about? Like what size of the deals?
So this deal was 52 units, so 8.7 million. So preferably, I'd like to be like 70 or 80 units or bigger where you can have on-site staff. But for this property, like the management company that I'm using, there's multiple properties in the area that they're managing, and it's pretty easy to share a manager for this property. But yeah, I'm not necessarily looking for land to build. I've never done any development, so this is kind of a good start to build these 12 units, dip my toe, see how I like it, see if we want to do more of it. But yeah, I'm kind of just, I guess I wouldn't say I'm completely looking left when everyone's looking right, but I'm kind of trying to not go where all the masses are going. And I don't mean I'm not running to retail right now, but I'm trying not to go to, everyone is looking for value add and they're paying compressed cap rates for it. Yeah. There's a higher risk. You got to go spend more money. There's more deferred maintenance. Yeah. And I found this, yeah, we can get the returns we need and take a lot less risk for this deal. So I'd prefer to do that all day.
And have you looked at the other, you know, commercial asset classes? You know, like there's a lot of people that I'm talking with, and they're now paying more attention to mobile home parks or storage units. So have you, you know, thought about those?
I have. My brother owns a self-storage facility, and he's looking at deals all the time. We haven't been able to find another one that pencils, but I've looked a little bit into mobile home parks, but there's just not a lot of parks from what I've seen. So there's just not a lot of deal flow. But yeah, I'm definitely open to looking at those as well.
Got it. So what you're currently having in the pipeline, like, I don't know how many deals you come across when it comes to, because, you know, there's people in multifamily space, they do complain a little bit when it comes to finding a good deals right now during the current market conditions. So maybe it's tougher right now to source deals, but still talking about that, like the deals that you have on the table come through, like how many deals are you planning to close on this year? Like, do you have a specific target, or you just like whatever happens, happens?
The market is really competitive. It's really hot. We're closer to the top of the market than the bottom, most would say. So I'm not putting as much energy into, you know, keeping on talking to brokers every day, you know, looking at deals every day. I feel like there's a time when it'll make more sense to put more time and energy into it. So yeah, I'm still in the market looking at deals, you know, talking to brokers, but I'm not necessarily just calling every, you know, seller trying to just figure out. I just feel like we're at a place in the market where you're to waste that much time and energy when the market is the way it is. It's kind of a,
Yeah.
I don't want to say an abusive use of your time, but
Yeah.
like you're pounding doors that it's not going to go anywhere anyways.
Yeah. So what do you think? Well, I mean, there's a lot of, uncertainty and now what's happening in the States, like with the elections, and a lot of people are waiting out kind of and seeing what's going to happen after that's going to be done. And they want to see the direction this market is going to take. But what is your overall approach? Like, what do you think is going to happen? Like, of course, there is no crystal ball, but overall, just like your personal view on the markets, where do you think real estate is going to go? Which direction? Is it going to be, correction happening right now? And I mean, we're going to come back to the times that it was before. Or, I mean, where's this everything going?
Yeah, I have no idea.
That's the best answer.
Being honest, but yeah, it's interesting. Like just today, they came out with the third quarter GDP growth was at 33%, which that was like kind of surprising to me. It's like a V-shaped recovery almost. So yeah, it'll be interesting to see with the election what happens. Either way, regardless of what happens, I feel like the Democratic Party, they're going to be probably trying to spend more money than the Republican Party, printing more money, funding more things. So we could potentially get, some inflation with that. So that would be good for real estate, even though some of the tax changes might not favor real estate as much. So I don't know, it could go a lot of ways. I feel like there's never going to be the perfect time to get into real estate. Like you can't buy at cheap prices, have the best debt, find investors that have money. Nothing like back in 2010, 2011, it was harder to get loans. There wasn't as available capital out there. If you're getting like a screaming deal, usually it's because it's not performing. You can't just buy at a 12 cap in a great market. So yeah, I mean, the best advice I would give is just to always be active in your market, keep it a pulse. Good deals can come about, in any parts of the cycle. And yeah, I don't feel like it's going to be anything like 2008 and 2009, just because lending is a little bit more intact. And we've already seen a bunch of layoffs, and at least in the markets I'm in, like assets are still performing well. There's not really any distress. That might be a different story in like a Las Vegas or a really touristy place. But then again, maybe you can buy at a discount, but it's going to be it might not be a cash flowing deal. So you can't just think that there's going to be a perfect time in the market cycle when you can buy at great cap rates and get great debt. Like there's something missing, and that's why you can usually buy at a discount. So
yeah, I mean, yeah, exactly. So it doesn't happen, that you're gonna get the capital available, the right deal, the right financing, like everything is gonna be in line. I mean, it doesn't even happen in the books, probably, like these things are just not real, right? So as you're saying, you have to, work the hand that you're dealt, basically with the cards that you have on the table, and you have to figure things out and approaches that you have to take and change maybe approach. And that's what you're going after right now instead of doing syndication and doing the JVs right now. But again, talking about the future, and again, what you're saying, coming back to the, inflation, which is a big word. It sounds scary to the people who have some capital available, in a bank, or maybe it sits in a stock market. It sounds like that money is going to go down in value. So how you can preserve, your capital with, let's say, multifamily, let's say, if you're in the future, we'll open up those multifamily deals for, as a syndication, traditional syndication for the passive investors. I mean, how people can invest in syndications, maybe you can explain to those people.
Yeah, depending on everyone's situation, it's going to depend on if they're, if they have a W-2 job or they've got an active business that they're in. It's going to be a little bit harder to get active, at least right away, into the business. And syndication is a really good model where if you can vet sponsors, find one that you like and trust, and invest with them, you can be preserving your capital and hedging inflation, growing it while you continue to work your job or your business. And I feel like it's a good way to dip your toe into commercial real estate. And if you want to get more active into it, there's a lot of people that start out that way. They invest passively, then they become a co-sponsor with kind of a lead sponsor on a deal, and then they kind of run their own deal. I've seen that happen multiple times with many people. I've never done like one of these mentorship groups where you pay and you're around a network. I can't really speak to that because I haven't done it, but I've heard of a lot of people have success with that where you can kind of follow that method. I don't know if that answers your question.
Yeah. Oh no, definite answer. So yeah, again, there is, of course, there is a ways that you can learn about syndication by investing passively. And yeah, I came across a lot of those people who have been, they've been a deal sponsor and they've been a passive investor and now they're running their own personal deals. But again, it's just coming back to the fact that, maybe it's harder to find your own deals. And again, if you're starting out a multifamily business right now during the COVID, it could be, a rough beginning, but again, it's if you're gonna become successful during these times in multifamily, which of course you can, you'll be good from here. So, but talking again, managing the deals, because maybe there's some people who are watching this episode and they say, look, I want to be active in my own, as a GP on my own multifamily deals. What would you recommend for people when it comes to management, services? Like, because you have the deals in Texas and now you're personal in Utah. So how do you vet and, the potential property management?
Yeah, good question. So for sure, I would say use third-party property management beginning. Unless it's like a under 5, if it's really small, it's good just to learn how it works, and it's not like you're risking millions of dollars on the line. But for larger properties, yeah, definitely do third-party property management. Just talk to people that already own properties in your market, whether that's at real estate conferences. You can just call property management companies and start interviewing them. How do they report? Have them show you assets that they currently manage, how they're performing, how do they report to you? Just being able to have a professional manager on a deal where you can oversee all their reporting, check in. It's so much more of a scalable model than if you're in the day-to-day trying to sign leases yourself. And because at the end of the day, most people get into real estate because they want that passive income. They want to have more time with their family, be able to do what they want. So that's kind of the ultimate goal, I feel like. Even if you're starting out managing yourself, if you can, either get employees to do it or you're hiring third party, that's definitely the way to go.
Yeah. Great advice. I love the fact that, if you're saying, depending on, size of the units that you have, again, if it's 5 or, less unit count and you have 4 units and you're managing those and learning kind of day-to-day operations and what it takes to actually manage and maintain those properties. And then you can take your personal experience when it comes to, vetting potential, property management, take your experience and you kind of vet them from there. And of course, there's additional information, like books and YouTube videos, all those free resources that kind of give you answers on vetting process. But it is awesome, definitely. So again, like what is currently going on, with the market and like the things that you're planning to do in the future with your own personal portfolio? Like, do you see, is there a specific number of the numbers like that you want to hit until the end of the year? If I didn't ask you the question that you're looking to close on until the end of the year.
Right. I don't have anything under contract right now. I'm about to make an offer on a 12 unit. Over the years, I've went back and forth over this where I just focus on larger stuff, and then I get a good deal that's smaller that comes across my desk and you can't resist. This property is close by, so I'm going to be making an offer on it, but I don't really have a number. I used to have a number, 5,000 units. But like this property I just closed, it's 52 units and I'm making 6,000 net a month on it. Like, that's, do a few more of those deals, that a couple hundred units where you have a good amount of ownership and they're cash flowing great. Like, I don't know. I've just kind of changed my I guess view on it over the
Like,
years.
it does make a lot of sense because, as you said, coming back to the fact that a lot of people, even though during these market conditions when it doesn't make sense to actually to go and hunt these deals down, and we're talking 200 300 unit properties, like you kind of scaling back on your approach, which I think, like, you're not the first one that I had on a podcast and they told me exactly the same thing. Instead of doing syndications, I'm doing JDs right now, scaling back to the unit count, and that's what I'm getting right now, because that's what's going to work for now, because it's easier to manage, and of course you can like close on, it's easier to find these deals also, instead of,
Yeah,
because
exactly.
nobody's is going for them right now.
Right. Yeah. Everyone's looking for the 150 plus unit deal, especially in really hot markets like Salt Lake City. There's this institutional money where they'll buy a low 4 cap deal if the unit count is there, and like I can't compete with that. So I either got to go to another market or I got to go a little bit smaller unit count. I'd like to sell to them. Like this deal, we're at 52 units. If we build 12, we'll be at 64 units. And as values rise, as rents grow, they might start looking at that kind of stuff in a few years. So that might be my exit plan, but it's just hard to get into the bigger deals.
Is that where the funds will be paying attention to? Is there like a threshold for them, kind of target that they're looking for, like a unit count that they're looking to acquire? Because I heard, like, from single family perspective, this should be at least like 120, 150 homes as a portfolio that the fund will come in and buy. So is there a specific number for multifamily as well?
I don't know. I think it depends a lot on the market. So it's complete when you're talking about a 50 unit in like a Salt Lake City compared to even like San Antonio, Texas, that's completely different buyer pools, complete, one thing I'd like to talk about is the expenses, for example. So like in Idaho and Utah, property taxes, it's like 0.5% of the purchase price versus Texas and Florida, it's like 2% of the purchase price. That's 4 times more. Same with insurance. Insurance is a lot lower cost in like Idaho and Utah. There's a lot less natural disasters, and we're not by a coast. So like if you're just looking at a rent to price ratio, or you're just looking at prices, a lot of people make the mistake of trying to buy that deal at $30,000 a unit in Memphis when the rents are $450 and the expenses are $400 a month. Like there's no cash flow, even though you're buying it so cheap. And so you got to be, every market is unique. You got to know the expenses in that market. You got to know the rents. You got to know the other income to really know whether there's cash flow or not. Because cash flow is where it's at. That's what you got to look at.
The king, right? Cash flow is the king.
Yeah.
For the business. So can you talk about, again, talking about the cash flow and the rents, because during the COVID times, there are some operators who are talking about, having some difficulties when it comes to the rent collections, because due to unemployment, that some of the people not working in the properties. So how do you go about personally? And of course, like, because again, maybe not personally, because you have a third party management. So what are they currently doing to make sure that the process for the rent collections is running as smooth as possible?
With my portfolio, we haven't had hardly any problems. We've had like 1 job loss on that 52 unit. I haven't had any job losses on my smaller portfolio. And then the Texas stuff, I'm not asset managing that. My partner is. So I'm not, from what I've seen, there hasn't been a lot of disruption. So I mean, I could speak of what I've heard other people do, but I personally, no, we haven't really dealt with a lot of those issues.
Awesome, awesome. Good, good, good for you and for your business. So awesome. So one thing that I wanted to ask you again, because you're building now personally a business, and you're looking for now a different, like still looking for multifamily deals in Utah and Idaho, and maybe some other markets, and you're still looking to bring on partners, but again from JV side, and you're going on podcasts just like this one, which I really appreciate you coming on and sharing your personal experience and journey in real estate business. But again, is there a legacy part involved? Because I see the photo in the background, which is you and your wife, I assume.
Oh,
That's awesome. So again, can you talk about the legacy part? Like, what type of legacy do you want to leave behind you? Is there that part involved also?
yeah, that's really fun to talk about. So yeah, we've got a daughter too. She's 3.5 months old. So
Congrats.
yeah, and I come from a family of 6 kids. So yeah, we have a lot of conversations about generational wealth. How do we preserve this wealth, pass it down, and then pass it down to my kids, and then how do we install good values of my kids to know how to preserve it, grow it, not spend it, so that they can pass it down to their kids. So it just goes back to education. How do you manage these assets and preserve the wealth. So yeah, just trying to, it's going to be exciting for me once my kids are old enough to get more involved in the business and try to teach them the day-to-day stuff. And
here you go. Yeah. So just breaking the chains off, instead of going from your family business as it was, agriculture, kind of, doing that type. Now it's real estate, and it's, assets and, expenses, income, cash flow, and, managing the property. So it's like really like handling the business, side of the real estate. So that is awesome. The fact that you want to, again, provide the value for the children, and to make sure that it's a generational thing for you and a family. It's awesome. So I love it. Cool.
Yeah, thanks. Appreciate it.
So guys and girls, before we're going to go, just I want to ask you one thing. If you share this episode with a friend of yours who wants to learn about real estate investing, and maybe again, as an active, investor in finding deals, closing deals, so what type of deals to look for. And again, it's all about multifamily in this episode. Or maybe the person who is looking to invest passively, and maybe when Levi will have those type of deals available, make sure to get in contact with him. Again, those links are going to be down below for Instagram, Facebook, and the website that's called wealthcreationmgmt.com. And make sure to go and follow up with Levi and ask all those great questions. And I'm sure he will spare a few minutes to answer those questions about investing. So Levi, again, big thank you again for joining me today on this episode and sharing the value, the journey, and all the great tips for real estate investing.
Yeah, thank you, Martinez, for having me.
Thank you again. So guys and girls, make sure to share this episode. And as always, I'll see you next time. Thanks for watching.